Welcome to the deep dive. Today, we're tackling a subject that might sound a bit niche, but it touches on industries that are absolutely fundamental: agriculture. You sent over a fascinating set of materials from the actual IAS 41 accounting standard itself to some really insightful real-world case studies and different perspectives from the industry.
Yeah, quite a stack.
Our mission today is to cut through the complexity and understand how the financial world tries to capture the unique economic realities of living, growing things and, the food and materials they produce.
That's right. We've got a really comprehensive collection here.
Mhm.
We have the IAS 41 standard, including the thinking behind it from Hong Kong and the IASB. Then there's a great fact sheet that boils down the key elements.
Helpful summary.
Definitely. We also have an issues paper from the Asian Ocean and Standard Setters Group that's a collection of accounting standard setting bodies in our region, which offers some interesting viewpoints. Plus, we get a look at how a Peruvian small business navigated adopting IAS 41, an academic paper giving us a broader sector view, and a crucial reminder about being careful with information in this area.
Exactly. So the core question we're diving into for you is this. How does the accounting world actually deal with things that are alive and constantly changing: your forests, your livestock, the crops in the field?
Hmm.
And importantly, what does this tell us about the financial health of agricultural companies and even their impact on the environment? Okay, let's unpack this by starting with the very foundation. What exactly counts as agricultural activity according to IAS 41?
Well, the standard is quite specific. Agricultural activity is defined as the management of the biological transformation of a biological asset for sale into agricultural produce or into another biological asset.
Okay.
Think of it as actively guiding natural processes for, well, economic gain.
Biological transformation. That sounds almost like something out of a science textbook. Can you break that down in simpler terms, maybe in the context of farming?
Absolutely. At its heart, it refers to the natural processes of growth, degeneration,
Hmm.
which could be things like, disease or spoilage production, and procreation.
Right.
And all these result in an increase or decrease in the value or quantity of a biological asset.
Hmm.
So, for example, with a dairy cow, that's it growing to maturity, perhaps getting sick, producing milk, and having calves.
Okay.
For a wheat farmer, it's the seeds germinating, the plants growing, and ultimately producing the grain at harvest.
Yeah.
Simple as that, really.
Okay, so it's more than just letting nature run its course.
Yeah.
There needs to be some level of human intervention, some active management involved.
Precisely. The standard really emphasizes this management aspect. This is what distinguishes agricultural activity from, say, just harvesting wild berries or cutting down trees in a completely unmanaged forest.
Ah, okay.
It involves actively influencing the conditions, things like controlling the nutrients in the soil,
Mm-hmm.
managing breeding programs for animals, or, protecting crops from pests and diseases.
Mm.
And the goal of this management is always to produce either agricultural produce, like that milk, wool, or harvested timber, or more biological assets, such as raising young chickens to become egg-laying hens.
So, to make this really concrete for you, can you give some clear examples of what falls under this definition of agricultural activity?
Sure. The standard itself and our sources provide several good illustrations. We're talking about raising livestock of all kinds: cattle, sheep, pigs, poultry, even fish farming through aquaculture.
Aquaculture, too.
Yeah.
Sure.
Forestry, meaning the management of timber plantations, and the cultivation of orchards and vineyards. Basically any scenario where you're managing plants over multiple seasons to yield fruit, grapes.
Right. A really diverse range of living things. Now, let's consider the boundaries. What specifically does not fall under the scope of IAS 41? I can imagine there might be some areas where it's not immediately clear.
You're right. There are related areas covered by other accounting standards. The most significant exclusion is the land itself, even if it's being used directly for agricultural activity.
Even the farmland.
Yeah, the land is accounted for under IAS 16, which deals with property, plant, and equipment, or under IAS 40 if it's considered investment property.
Mm.
So you wouldn't account for a field where crops are grown in the same way you account for the growing crops themselves.
That distinction makes sense. What else is outside the scope of IAS 41?
Another key exclusion is bearer plants. These are plants that are used repeatedly to bear produce over multiple periods. Think of fruit trees, grapevines, or rubber trees.
Ah, the long-term producers.
Exactly. These
Oh.
are now accounted for under IAS 16 as well. However, and this is a really important distinction for you, while the plant itself is under IAS 16, the produce from those bearer plants, like the apples, grapes, or rubber latex,
Fruit.
does fall under IAS 41 at the point it's harvested. So the apple tree is IAS 16, but the apples you pick from it are IAS 41 right up until they are harvested.
Okay, that's a crucial difference to keep in mind. What other areas are excluded?
Government grants that are specifically related to those bearer plans are covered by IAS 20, which deals with accounting for all types of government grants.
Got it.
Any intangible assets that might be linked to agricultural activities, such as, say, water rights or production quotas, fall under IAS 38.
Intangibles, right.
And if a company is leasing land for agricultural purposes, the accounting for the right to use that land would be under HKFRS 16. That's the Hong Kong Financial Reporting Standard 16, which deals with leases.
Mhm.
So it's a bit of a mix, depending on the specific type of asset or activity.
It sounds like you need to know your accounting standards pretty well to navigate all of that. Now, what happens once the crop is harvested or the animal product is collected? Does IAS 41 still apply then?
This is a critical point.
Yeah.
IAS 41's reach stops, well, right at the point of harvest.
Okay.
Once the agricultural produce is detached from the biological asset, so the wheat is cut, the milk is collected, or when the biological asset's natural life processes cease to provide that produce, that's considered harvest. Any further processing of that agricultural produce after harvest, like turning those grapes into wine or that milk into cheese, falls under IAS 2, which is all about inventories, or other relevant accounting standards depending on the nature of the processing.
Ah, inventories.
Yeah. Even if that processing is a natural and expected next step in the agricultural business, it's outside the scope of IAS 41.
Interesting. So the grape farmer accounts for the grapes under IAS 41, but the winery then switches to IAS 2 for the wine they produce from those same grapes. Okay, now let's get to what our sources really emphasize as central to IAS 41, fair value. What's the core idea behind using fair value in this context?
Well, the fundamental principle of IAS 41 is that biological assets in agricultural produce at the point of harvest are measured at fair value less costs to sell.
Okay.
The underlying idea here is to try and reflect the current market value of these assets as accurately as possible.
Fair value. That can sometimes be a bit of a slippery concept, can't it? How exactly is it defined here, and what are these costs to sell that are deducted?
Yeah, it can be tricky. Fair value is essentially the price that would be received if you were to sell an asset in a normal, orderly transaction between knowledgeable, willing buyers and sellers
Right.
at the specific date you're measuring it. Costs to sell are the extra costs directly associated with getting rid of the asset. This could include things like commissions for brokers or agents, fees charged by regulatory bodies or commodity exchanges, and any taxes or duties on the transfer.
So not financing costs or income tax?
No, exactly. What it doesn't include are financing costs or income taxes. So if you're selling, say, a truckload of timber, the fair value would be the market price you'd get minus any brokerage fees you'd have to pay to make the sale.
So when a farmer harvests their corn, they need to figure out what that corn is currently worth on the market and then take away any costs they would directly incur to sell it.
That's the core principle. And importantly for understanding the financial reporting, when a biological asset is first recognized, say a new lamb is born, or when agricultural produce is initially recognized at harvest, any profit or loss that arises from measuring it at fair value, less those costs to sell, is usually included in the company's profit or loss for that accounting period.
Right away.
Yeah. The same applies to changes in the fair value of a biological asset over time as it grows and matures. So if that new lamb's fair value is estimated at $50, that gain is immediately reflected in the financial results.
So it's about trying to capture the economic changes as they happen with these living assets. Now, our sources do suggest that measuring fair value isn't always a simple task. When can a company argue that fair value cannot be reliably measured?
Well, the standard operates on the assumption that fair value can be measured reliably for biological assets. However,
There's a but.
there's a but. This assumption can only be challenged on the initial recognition of a biological asset, and it's only in very specific and rare circumstances.
Like when?
This would be when quoted market prices aren't available, and other methods of estimating fair value are deemed clearly unreliable. It's intended to be a very high hurdle to clear. The standard really pushes for fair value to be used whenever possible.
And if, in those limited cases, fair value can't be reliably measured when the asset is first recognized, what accounting treatment is used then?
In those exceptional situations, the standard allows the biological asset to be measured at its historical cost, minus any accumulated depreciation and any accumulated impairment losses.
Okay, cost model then.
But it's crucial to understand that this is meant to be a temporary fallback. Once the fair value of that asset becomes reliably measurable, the company must switch to measuring it at fair value, less costs to sell. The goal is always to get to fair value as soon as it's feasible.
So the intention is definitely to move towards fair value as the primary measurement. Now, earlier we touched on bearer biological assets like fruit trees and how they've moved under IAS 16. This seems like quite a significant change. Can you explain the reasoning behind this shift and what it means in practice?
Yeah, this was a subject of considerable discussion and debate, as our sources, particularly the paper from the AOSSG, highlight.
Right.
Bearer plants, like those fruit trees or grapevines, are now accounted for more like traditional property, plant, and equipment under IAS 16.
Okay.
This is because their primary purpose isn't to be consumed or sold themselves, but rather to repeatedly bear agricultural produce over multiple accounting periods. Think of an apple tree. The value to the farmer isn't in selling the tree itself in most cases, but in the apples it produces year after year.
So the accounting focus shifts from the biological changes in the plant itself to its capacity to generate a stream of produce over its useful life. Makes sense.
Exactly. The cost model used in IAS 16, which includes depreciation to reflect the wear and tear or obsolescence of the asset over time, is seen as more relevant for these types of assets.
But the fruit is still IAS 41.
Yes. As we discussed earlier, it's vital to remember that the produce, the yield, the apples, the grapes, etc., still falls squarely within the scope of IAS 41 and is measured at fair value at the point of harvest.
Oh,
So the tree depreciates under IAS 16, but the fruit is valued at its current market price under IAS 41 when it's picked.
Okay, got it. The AOSSG paper mentions some specific concerns from financial analysts regarding the use of fair value for bearer assets before this change. What were they worried about?
Well, the analysts surveyed by the AOSSG expressed concerns that using fair value accounting for the bearer assets themselves could potentially distort a company's reported earnings.
How so?
They felt that the valuations of these long-lived plants could rely too heavily on subjective assumptions about future yields, market prices, discount rates,
Mm-hmm.
all those variables.
Right, lots of estimates.
Yeah, making it difficult to get a clear and reliable picture of the company's financial performance. Some even suggested that information about the fair value of bearer assets might be more useful as supplementary information disclosed in the notes to the financial statements, rather than being a direct part of the main financial figures.
It sounds like there's a real tension there between the theoretical ideal of fair value reflecting current market conditions and the practical challenges of applying it reliably and consistently to certain types of biological assets.
Absolutely. And this brings us to some of the general difficulties in applying fair value measurement to biological assets more broadly. One of the most significant challenges is that for many types of biological assets, especially those that take a long time to mature,
Like timber.
exactly like timber in a forest or certain types of livestock, there aren't always active and liquid markets where you can easily observe prices.
So if there isn't a readily available market price, how do companies go about determining the fair value of these assets? What do they do then?
Well, in the absence of active markets, the standard provides a kind of hierarchy of approaches. Companies can use market-determined prices for similar assets, making adjustments for any significant differences in characteristics like age, quality, or location.
Okay, compare to similar things.
Right. Another common technique is to calculate the present value of the expected future net cash flows from the asset.
Discounted cash flows, DCF?
Yep, DCF. This involves forecasting all the cash inflows and outflows related to the asset over its expected life, and then discounting those future cash flows back to their present-day value using a current market-based discount rate.
Right.
Think of a discount rate like an interest rate in reverse. It helps us understand the present value of money we expect to receive in the future. The key is that it needs to reflect the risks involved in receiving those future cash flows.
Discount rates. That sounds like it could introduce another layer of complexity and potential for different interpretations, doesn't it?
It certainly can. The standard used to specifically mention using a pre-tax discount rate, but that guidance was actually removed in later updates. Now, the important thing is consistency. If you're discounting after-tax cash flows, you should use an after-tax discount rate, and if you're using pre-tax cash flows, use a pre-tax rate.
Makes sense.
And when using these discounted cash flow models, companies also need to factor in the risks associated with those expected cash flows. This risk can be reflected in either the cash flow projections themselves or in the discount rate that's applied, or even, a combination of both.
The basis for conclusions document also mentions something called additional biological transformation. What exactly does that refer to?
Yes. This refers to further biological changes that are expected to occur in the asset beyond its current condition at the measurement date.
Like future growth.
Yes, exactly. The amendments to IAS 41 clarified that when companies are using discounted cash flow models to estimate fair value, they should take into account the increases in cash flows that are reasonably expected to arise from this future biological transformation, such as the continued growth of a tree or the further weight gain of livestock.
Okay.
However, they also need to make sure they're realistically considering the risks associated with achieving that future growth and those increased cash flows. The idea is to get a fair value that truly reflects the asset's full economic potential.
It's interesting how the standard tries to capture not just the present value, but also the future potential inherent in these living assets. Now, our sources also mention that in certain situations, the historical cost of a biological asset can be used as an approximation of its fair value. When is that considered acceptable?
Yeah, cost can be a reasonable proxy for fair value in two main scenarios. The first is when there has been very little biological transformation since the initial costs were incurred. For example, very young seedlings that have just been planted or livestock that has only recently been acquired.
Right, not much change yet.
Exactly. In these early stages, the market value might not have diverged significantly from the initial cost yet. The second situation is when the impact of the biological transformation on the price is not expected to be significant.
That's jazz.
This might be the case during the very early stages of growth in a long-cycle plantation, like a pine forest that takes decades to mature. In those initial years, the growth might not yet have a material impact on the market value.
That makes sense. In the very early stages, the cost might be the best or at least a reasonable indicator of value. What about when biological assets are physically attached to the land, like trees in a forest or grapevines in a vineyard? How do you determine their fair value separately from the land itself? That sounds tricky.
It can indeed be a tricky area because often there isn't a separate active market for the biological asset independent of the land it's on. In these situations, the standard allows for a valuation technique where you determine the fair value of the combined asset, the land, plus the biological assets, and then you deduct the fair value of the land itself and any improvements that have been made to the land.
Ah, the subtraction method.
Pretty much. The example of wine growing is often used here where this difference method can be applied. So you might value an entire vineyard property and then subtract the estimated value of just the bare land to arrive at an implied fair value for the grapevines.
So you value the whole package and then back out the value of the non-biological component.
That's the general approach. However, our sources also point out a potential limitation of this method. It can become problematic if the value of the land alone is higher than the assessed fair value of the combined property.
Oh,
Yet in such cases, subtracting the land value could result in a negative implied value for the biological assets, which doesn't really make economic sense.
right. You can't really have a negative value for a living asset. So it seems like while the concept of fair value is central, its practical application in the agricultural sector can be quite complex and requires a good deal of judgment. This must have significant implications for how agricultural companies present their financial results and how investors analyze them.
Absolutely. As the academic paper we looked at emphasizes, the accurate application of IAS 41 is really vital for market participants to properly assess the natural capital risks associated with agricultural companies.
Natural capital risks.
Things like deforestation, soil degradation, and loss of biodiversity. These can have a very real impact on the long-term value and sustainability of a company's biological assets. If reporting isn't accurate, it can really distort the perceived financial performance and the environmental footprint of these businesses. So for you as someone interested in sustainable investing, understanding how these natural assets are valued is crucial.
So, if a company isn't properly accounting for, say, the impact of unsustainable logging practices on the future value of their timber forests, investors might be getting a misleadingly positive picture of their financial health.
Exactly. The standard actually requires companies to reassess the fair value of their biological assets when there are significant changes in these natural capital risks.
Oh, interesting.
For example, if a major disease outbreak affects a livestock herd or if a wildfire sweeps through a timber plantation, the fair value of the remaining biological assets would need to be adjusted to reflect the loss and any expected changes in future productivity.
Our sources included some real-world examples of how these accounting principles can play out, both in terms of increased transparency and in situations where things went wrong.
Let's talk about the case of Stora Enso. What did they do that was noteworthy?
Ah, yes. Stora Enso. They're a large forestry and packaging company, and they made a deliberate move towards greater transparency in how they report on their forestry assets.
They actually reorganized their reporting structure to more clearly separate the performance of their forest holdings. They also started to categorize the changes in the fair value of these biological assets into what they considered operational changes.
Like growth and harvest.
Yeah, related to the natural growth and harvesting cycles, and non-operational changes, which might be due to market price fluctuations or changes in valuation assumptions.
Ah, separating the drivers.
Exactly. This provided investors with a much more detailed understanding of how their forestry assets were being valued and the different factors that were driving those changes in value.
That sounds like a positive step towards giving investors a clearer picture of the underlying performance of their forestry business. On the other hand, we have the cautionary tales of Zonoco and Noble Group. What happened in those situations that highlights the importance of proper accounting for biological assets?
Oh, these cases really underscore the potential risks and consequences of misreporting in this area. Zonoco, a Chinese scallop producer, experienced massive and repeated die-offs of their scallop stocks.
Wow.
Huge losses. The investigations that followed raised very serious questions about potential accounting fraud and whether they had been accurately reporting the value of their biological assets under IAS 41.
Suspicions of fraud.
Yeah, there were suspicions that they might have been using vague explanations like climate change to mask underlying financial issues. Ultimately, their auditors couldn't get comfortable with their financial results after these die-offs, leading to canceled asset sales and regulatory sanctions. These examples are really eye-opening and show just how critical it is to get this accounting right.
It sounds like there were significant doubts about the reliability of their reported asset values in the face of these unexplained losses. What about Noble Group?
Noble Group, which was a major commodity trader with significant palm oil assets, faced substantial write-downs in the value of those assets.
Write-downs. Why?
Well, questions were raised about whether their earlier valuations had adequately taken into account factors like the increasing costs associated with deforestation and forest clearance, both from a regulatory and reputational standpoint.
So environmental costs weren't fully factored in?
The suggestion was that they might have been overvaluing their assets by not fully considering these environmental and social risks. So in both cases, whether it was the disappearing scallops or the potential underestimation of environmental liabilities, the misapplication or lack of transparency in accounting for biological assets had significant negative consequences, including investigations and major financial impacts. Absolutely. These examples highlight the critical importance of having reliable fair value accounting and the potential for misleading information when it's not done properly.
Yeah.
The level at which an asset's fair value is determined whether it's based on readily observable market prices, which are categorized as level 1, prices for similar assets in less active markets, level 2, or based on a company's own estimates and unobservable inputs, level 3.
Level 3 is the tricky one.
Yeah, that level has a big impact on transparency. Many biological assets tend to fall into level 3, which, as our source noted, can be seen as more of a mark-to-management approach and inherently less transparent than valuations based on active market transactions.
Mark-to-management.
It makes you think about how much trust investors need to place in these valuations in the agricultural sector.
This all really underscores the important role of auditors and regulators in ensuring that IAS 41 is being applied consistently and accurately in the agricultural sector. Now, let's shift gears slightly and talk about government grants. How are these accounted for when they relate to biological assets under IAS 41?
Okay, government grants. The accounting treatment depends on how the related biological asset is being measured.
Fair value versus cost again.
Right. If the biological asset is measured at fair value, less cost to sell, then an unconditional government grant that's related to that asset is recognized as income in profit or loss when the grant becomes receivable.
As income, okay.
You don't deduct the grant from the fair value of the biological asset itself, because that would go against the principle of reporting at fair value.
What if the government grant comes with conditions attached, like a requirement that the entity doesn't engage in certain types of agricultural activity?
Good question. In the case of conditional grants, including those that might restrict certain activities, the grant is recognized as income only when those conditions have been met.
Makes sense. Meet the conditions first.
Yep. And if the government grant relates to a biological asset that is being measured at cost, because fair value cannot be reliably determined, then the general accounting rules for government grants under IAS 20 apply.
And what does IAS 20 say?
Well, IAS 20 does allow for the grant to be deducted from the carrying amount of the asset in some circumstances. So the accounting depends on whether you're using fair value or cost for the biological asset itself.
Okay, so a clear distinction based on the measurement basis. Now, what kind of information are companies required to disclose to investors about their biological assets and agricultural activities under IAS 41? Transparency is key, right?
Absolutely. The standard has quite specific disclosure requirements that aim to provide transparency to the users of financial statements. Companies must disclose the total gain or loss that they've recognized during the accounting period,
The bottom line change.
from both the initial recognition of their biological assets and agricultural produce at harvest, and from any changes in the fair value of their biological assets during that period.
And are they encouraged to provide even more detail than just the total gain or loss?
Yes, particularly in situations where the production cycle for their biological assets is longer than 1 year, the standard encourages companies to separately disclose the effects of physical changes.
Like growth, death.
Yeah, things like growth, harvest, or degeneration, and the effects of price changes on the fair value of their biological assets.
Ah, physical versus price.
Exactly. Breaking it down like this can give investors a much better understanding of the underlying drivers behind the changes in value. Companies also need to disclose any significant items of income or expense that arose from events like disease outbreaks or natural disasters that impacted their biological assets.
And for those limited situations where biological assets are measured at cost, are there any specific additional disclosures required? You mentioned that earlier.
Absolutely. In those cases, companies have to provide a detailed description of the biological assets being measured at cost, along with an explanation of why fair value is considered not to be reliably measurable.
Justify the cost method.
Precisely. If it's possible, they also need to disclose the range of estimates within which the fair value is highly likely to fall. Additionally, they need to disclose the depreciation methods they're using, the useful lives or depreciation rates applied to the assets.
Standard depreciation stuff.
Right. And if, at a later date, the fair value becomes reliably measurable, they have to explain the reasons for that change and disclose the financial effect of switching to fair value.
Yeah.
So even when cost is used, there's a push for as much transparency as possible.
So it's all about giving investors the clearest possible picture, even when fair value can't be directly applied. Now let's zoom out again and look at the global adoption of IAS 41. How widely is it used, and are there any notable differences in how it's applied around the world?
Well, many countries have adopted International Financial Reporting Standards, IFRS, which includes IAS 41. So it's pretty widespread theoretically.
But
As the Peruvian case study we looked at highlights, the actual level of compliance and the emphasis placed on it can vary, particularly for small and medium-sized enterprises.
SMEs.
Ah, the SME challenge.
Yeah. In Peru, for example, it's quite common for SMEs to continue to rely on tax regulations, which often use historical cost accounting, for preparing their main financial statements, even though IFRS for SMEs is the officially recognized standard.
So local tax rules often win out. It seems so sometimes. This shows that even when a standard exists, practical adoption can be influenced by local regulations and the perceived costs and benefits of implementing it fully.
That's a really important point, that the existence of a standard doesn't always equate to uniform application on the ground.
Exactly. However, that Peruvian case study also provided an interesting counterpoint because the forestry SME that did adopt IAS 41 and fair value accounting found that it actually helped them to attract external financing.
Oh, really? How?
Well, the fair value accounting gave potential lenders a clearer and more up-to-date view of the value of their timber assets. Made them look more credible, I suppose.
Interesting. Any other examples of variation?
Australia provides another example. They have a two-tiered financial reporting system. Tier 2 entities, which are generally smaller companies without public accountability, have reduced disclosure requirements related to IAS 41 compared to the larger, publicly listed Tier 1 entities.
So less burden on smaller companies.
Right. So while the fundamental principles of IAS 41 might be widely accepted in countries that use IFRS, the specifics of how it's applied and what information needs to be disclosed can differ depending on the local regulatory environment and the size and nature of the company.
So it's a global standard, but its application has local nuances. Well, this has been a really insightful deep dive into the intricacies of accounting for agriculture under IAS 41. We've seen that it's a complex area with a core principle of using fair value to account for living and changing assets.
Yes, and we've really unpacked the key insights for you. The focus on fair value is intended to provide a more current and relevant view of the financial realities of working with biological assets. However, we've also discussed the significant practical challenges that arise in reliably measuring fair value, especially when active markets don't exist.
Right, the valuation challenges.
And the evolution of the standard, as seen in the shift of bear plants to IAS 16, highlights the ongoing efforts to refine these accounting rules. It's not static.
And the real-world examples we looked at, like the situations with Zonaco and Noble Group, really drive home the point of just how critical it is to apply these principles correctly and transparently, and the potential consequences when they're not.
Indeed. And considering the increasing global focus on issues like sustainability and natural capital, it leads to a really important question for the future. How might accounting standards like IAS 41 need to continue to evolve to better capture the environmental impacts and the dependencies of agricultural activities?
That's a big question. And for you, the listener, we hope this deep dive has illuminated how understanding these seemingly technical accounting principles can give you a much deeper understanding of the companies and industries that shape our food systems and the world around us.
Yeah, it's more than just numbers.
It's clear that even the fundamental act of growing food or timber is deeply intertwined with intricate financial considerations and reporting standards that have far-reaching implications for investors, regulators, and the environment itself. Thanks for joining us on the deep dive.